Everyone, welcome to the episode. Today we have a very special guest, and that's Roger Dent. Roger is the CEO of Quinsam Capital. I believe, Roger, Quinsam got started right around 2012, 2013. Is that right? Or you had purchased, you had bought into Quinsam around that time?
Yeah, that's right. Quinsam had been a very small public company for quite a few years, but it was more or less dormant. But around 2013, myself and a group of others bought the controlling block off of the former CEO, and we started a process to raise money in Quinsam to create a rejuvenated investment vehicle.
And one of the advantages of buying into Quinsam was that there were tax loss credits there, right? That could offset future gains. Can you talk about that strategy?
Yes, I mean, Quinsam at the time was a bit of a rare entity. It was an investment issuer according to the guidelines of the exchange, which allowed you to run an investment portfolio in it. And it did have a pool of tax losses, capital losses, also some income losses. So it meant that we were able to make quite a few $1 million in Quinsam before we would have to pay any income tax. And one of the beauties of the structure as a corporate entity, as an investment issuer, it meant that we were not offering investment advice to individual investors. So that meant we did not have to go through the entire portfolio management, regulation, and licensing costs, which are quite onerous for a very small entity. And it meant that we were able to basically run a portfolio of investments in a very lean, efficient manner with a very low-cost structure. And we've gone for the last 10 years with a cost structure that at this point is, perhaps $300,000 or $400,000 a year, which for a public company is a very, very low cost structure.
And then shortly after, let's say starting 2014, 15, we started seeing quite a few private cannabis companies start to go public. And you had decided that part of the strategy of Quinsam was to make a big, bold bet early on, a portfolio of cannabis companies. Can you walk us through that era of investing?
Sure. I mean, there was a time period where there were some initial entities in the cannabis space that were in the public markets, and we dabbled in a few of them among a portfolio of quite a lot of other investments. And we had some success, and a number of investment dealers came to us and said that they thought it would be viable to raise a significant pool of assets to deploy into cannabis investments. Our strategy at the time involved a lot of private to public transactions where you would invest in a late-stage private company that was looking to list, and you hope to get that valuation lift from private to public in the process. And there were a lot of cannabis companies going public. There were a lot of very big wins occurring on the private to public transition. As a result, we decided, well, let's pursue this opportunity in cannabis while it lasts. And we raised 3 different tranches of funding, and deployed into a variety of cannabis companies, mostly in this private to public transition stage. Some that were just public companies where we thought they had relatively attractive opportunities, but for the most part we were deploying into the last or second last private financing tranche as they prepared to list on Canadian exchanges.
And can you walk us through the biggest winner at the time and how you discovered that cannabis company?
I'm not sure that there was, a single one that stood out, head and shoulders above the others. At the time, it really was a wave. There were, we probably invested in, I'm going to guess, 50 different entities at the time. We were coming in typically in the, as I said, the last or second last financing before listing. So we were not necessarily getting in at the formation of these companies. So we had, a whole host of companies where we made, 50%, 100% type returns. And we had a few where, from clever structuring, we got, a highly leveraged return. So, one example, for instance, a company which, has not necessarily worked out that well over the long run, CDB Green, we got in as a mortgage lender on their facility, and we ended up with a lot of free shares. So we provided mortgage financing, they paid us back, but we ended up with, a big piece of the company for nothing. When your cost base is nil, obviously the return there is infinite. That sort of transaction was, quite appealing at the time.
And there's still opportunities in cannabis, and I know that most retail investors have just got up and just run away from the space altogether. But you're still finding some companies that are potentially viable. Like for example, there's a CBD.
Yeah, I mean, we still have
about.
a couple of investments that
Yeah.
that are in the space from that time, and one of them is a company that is called Asynaptic. It's not a traditional cannabis story, but what they have is a drug delivery technology that allows CBD to be absorbed into the system through the skin. Like at the time of 2018, 2019, there were all sorts of people out there that were offering CBD creams, but the reality is that in almost all the cases, the CBD was not very effective because it couldn't penetrate the skin. The molecule just was not able to transmit itself through. But what Asynaptic has is a technology that allows a very efficient transmission of CBD through the skin, and they have a transdermal patch which they're expecting to start an FDA trial on literally in the coming weeks. That allows basically CBD to be transmitted through the skin for treatment of childhood epilepsy. And this is a multi-billion-dollar opportunity. There are companies already offering CBD orally as epilepsy treatment. But the big problem with the treatment is that when you take CBD orally, it has a toxicity to the vital organs. And because transdermal drug delivery bypasses the organs, and because the dose is much lower, the upside with this transdermal product is that you can get the effective epilepsy treatment without the negative side effects. So we are hopeful that this trial is going to be underway, literally in the coming short period of time, and the company is planning on raising funds at a significant premium to where we're carrying the investment and list as 2025 progresses. So, this is a company that, we initially invested in probably 4 years ago, and it has over the last 4 years, done a study in Canada, which was successful, that proved the technology works. And then what they've been doing over the last 3 to 4 years is getting the plan in place to proceed with a FDA approval for this product. And it's had its challenges, because in the United States, CBD is still its legal status is still controversial, and it took quite a while to get U.S. partners in place that are willing to go ahead and do the trial. But we are expecting them to announce a trial with a very prestigious, well-known U.S. hospital to conduct the trial. And that's we think going to be a very major development for that company.
And so what I really like about you, Roger, is that your ability to discover companies very, very early on. I think one of your earliest investments was in California Nanotech. But what the the microcap and small cap investors will appreciate here who are watching this is that most of these companies you can't just screen, you can't just filter them and discover good companies. It's a much different discovery process. Can you walk through that process for California Nanotech?
Sure. Well, I mean, California Nanotechnologies, when we bought into it, the market cap was, maybe it was $1 or $2 million. It was a minimal market cap at the time. And the revenues were minimal. So any sort of financial screen would not really surface this idea. But what we like about it, and what we like about companies in general, like what I'm looking for is some sort of significant upside leverage. And in the case of California Nanotechnologies, the leverage came by virtue of the ultra small market cap. So I looked at it and thought that if this story could develop and could get a following, you can see that $2 million market cap, multiply by a very significant factor if it can get a following. So, at the time, California Nanotechnologies had some very promising metal technology, which it's had and developed over the last 10 years. What the application at the time that got me excited was that they had a plan to develop with a major oil field service company a drill bit that would dissolve when it was no longer needed. So the concept basically was you were going to have this ultra high performance metal drill bit used on offshore oil rigs, which have extremely high operating costs. And you were going to put the drill bit on the oil rig, drill the hole, and then once you got to the end of the drilling process, you would put chemicals into the hole and the drill bit would dissolve, and you wouldn't have to spend several days of very expensive offshore oil rig drill time pulling your drill bit out of the hole. So that was the concept, and the problem ultimately was that scientifically the process failed. That opportunity did not advance. But what the great thing about California Nanotechnologies has been that it's had very, very low operating costs, a dedicated team of people that have some very significant experience and expertise in nanometal technology. So the company was able to survive and grow to fight another day. And over the course of the last 10 years, what the company has developed, and I've been a director of it for 10 years, is this whole set of skills around nanometal technology, developing customer relationships, developing opportunities. And really what's happened is that the world has kind of caught up to its ability to create new metal products and has started to basically purchase them. So, I would say that, for many years, we kind of had a set of technologies and a set of skills that were cutting edge and, scientifically very interesting, but there wasn't much of a market for them. And what's happened, I think, particularly I'd call it the green revolution has brought with it scientific challenges where they need metals to be, lighter, stronger, have other enhanced characteristics, resistance to corrosion, these sorts of things. Where now, the market is there. And, what we've seen with California Nanotechnologies is that leverage really come through in a fantastic way, and the stock has gone up, it was probably up almost 40 times over a period of 2 years. It's cooled off a little, but it's still been a fantastic performer over the last couple of years. And now when you look at, the financial metrics, you can screen it and look at it as being an interesting stock because it's got now great revenue growth and it's got fantastic cash flow and it's got fantastic return on equity. And when you look at it operationally, we now also have a brand new, fully paid for state-of-the-art plant. The cash flow from the business has allowed us to pay off all the debt that we accumulated over, the last 15 years since the company was started. And we now have a customer base that is very interesting and includes many Fortune 500 names, NASA, U.S. national labs. Like in the advanced materials state, we're a member of a very esoteric group of companies that are developing some of these cutting edge technologies. So it's been a great performer. But what attracted me to California Nanotechnologies, apart from obviously the science and the opportunity, was the great leverage that was in the investment if the opportunity and the science came through. So, what I am looking for is, the upside in the story, but also, combining that with the leverage, which typically is from a very low market cap. But it's also, the operating characteristics of the business. So, another investment that we've recently participated in is a company called BlueMetric, where, it has leverage from a couple of different sources. First of all, it had quite a low market cap as public companies go. It had about a $25 million market cap. But, so it had leverage from the low market cap, but it also had leverage because of where it was in its kind of operating situation. It had basically got enough revenue that it was comfortably covering its overheads on a regular basis, but what was left over as an EBITDA contribution was not large. But it was large enough that you could put a reasonable multiple on it, even at a 25 million market cap. But what it has in terms of upside leverage now are some really interesting opportunities in the water space. We've also at BlueMetric just made a large acquisition in the United States, which takes us into new markets. So there's some really exciting leverage in where that EBITDA number can go in 25 and 2026 as these opportunities come to fruition. And I think when you take those sorts of opportunities and put it in juxtaposition to the market cap, which is now maybe it's 30 million, you can very easily see scenarios where that 30 million can multiply by 5 and become 150 million over the course of 2, 3, 4 years. So, that's one that, at the present time is a really exciting story for me.
And you also, Roger, very early on discovered VitalHub. Talk to us about VitalHub.
Sure. Well, VitalHub, is another situation with, the huge leverage from the very low market cap. So, VitalHub was a company that we helped take public back in about 2014. So within Quinsam, we created a capital pool company, a CPC, and went out to look for a partner company to take public, and VitalHub was that company. So at the time, VitalHub, I think, had a valuation of, as I recall, it was something around $1.5 or $2 million. It was a minimal market cap. The business was very, very modest. I think the revenue was at the time around $1 million. It was kind of breaking even, but basically, it was the team of Dan Matlow and Brian Goffenberg, the CFO, who had built successful software businesses in the past, and basically it was an opportunity to take that minimal market cap with a proven team and try to replicate the success of the past. And, to some degree, it was taking a chance on the team and whether or not they could, pull off the acquisition strategy. But, we believed in the team and, provided that initial pool of money to let them go out and start the acquisition plan. And over the course of the last 10 years, VitalHub has now grown to, a business with extremely significant growth, recurring revenue, cash flow. I'm going to guess that the number of acquisitions made is now something like 20. And we're now at VitalHub in a very enviable position where we've got a great enterprise value to EBITDA multiple, which allows us to raise funds and deploy them into acquisitions at lower multiples, and thereby grow the business. So it's sort of the perfect execution of the roll-up model, and we now have a business that on a quarterly basis generates free cash, which gives us more cash to deploy into more acquisitions.
Absolutely.
It really is, financially a beautiful business.
Yeah. Have you made any similar software tech investments recently through Quinsam?
I would say, we've not found too many since the pandemic. We did buy Boardwalk Software last year. To date, that has, from an investment perspective, not been a success. It's down from where we purchased it, but operationally, the business is progressing. Its market cap is still very low. It's under $10 million, and the upside leverage is there. And we think 2025 is going to be a good year for them. So it's got all the characteristics that allow that company to have exponential growth in the share price, but it's got to execute this year, which we think it will do. And I noticed that actually was on Ventum's top picks list for 2025 that they put out just in the last couple of weeks. But it's I think they like it for all the same reasons that we do. It's a very modest valuation in absolute terms. It's a low revenue multiple, but it's yet to get to generating significant EBITDA. But it's got that potential, and if it grows its recurring revenue base, which it's targeting to do this year, it should be able to get to EBITDA, positive EBITDA, without further return to the market to raise funds.
And then a company you also discovered early years ago, Acuity Ads, which is now known as Illumin Holdings. Can you walk us through that story of Acuity?
Sure. Well, Illumin is in the ad tech business, so it basically is a company that provides the technology that allows a company to purchase online or direct TV advertising that meets its demographic goals. So if you're Home Depot and you wish to reach people in certain geographic areas, or that have demographic characteristics that tie to the do-it-yourself market, you're trying to get a certain sort of customer when you deploy your ad budget. And what Acuity helps companies do is provide the desired demographics at the lowest cost. What Acuity offered, it had very good technology at the time of listing, a modest market cap. It was generating good cash flow, had a good team that had executed in the past. And it also had a roll-up strategy as well. And the company executed quite nicely over a period of years. And then in 2018, 2019, Trade Desk became a well-known play in the space, and it really provided some stock market leadership in the space, the ad tech space. And Acuity, we saw the share price probably multiply close to 10 times in the period of about 2 years. So it became a huge winner in 2020, and the company was able to raise some significant funds at the time. While the share price has fallen, we now have a business that's doing $100 million or more of revenue, generating positive cash flow, and we have a a very strong balance sheet to deploy here going forward. And the stock price has started to perform decently once again. We're probably up something like 50% over the last 12 months or so.
And some microcap investors, Roger, will just have a rigid system. Like, I will only invest in non-resource and oil and gas companies, but you don't have the same rigid system. So I want to kind of walk through that. For example, Saturn. Yeah.
Yeah. So the resource space, can be difficult to predict. Like, if you're in the business of drilling holes, looking for resources. Even geological experts, make all sorts of mistakes. You just don't know what is down there necessarily till you start drilling. So on the whole, taking risks on geology are not very interesting because I don't really think I've got the ability to predict. So there's the occasional time that we will make a speculative play in resources where you've got an extremely low market cap, and you're really more not so much betting on the geology, but more betting on whether or not this stock is going to be able to get a following based on news flow. But I would say, on the whole, not really looking for those sorts of plays. But if there are also resource plays, and Saturn Oil and Gas is one of them, where you're not really betting on the geology. I mean, Saturn is a significant oil producer, and it's making capital investments in the field on an ongoing basis, but they are very low risk development type plays. So really, in the case of Saturn, what it is it's a financial modeling exercise. So in the market cap size that Saturn is in, it is probably the lowest price to cash flow name in the space. It has a little bit more debt than some, but we think the debt is very manageable, and in the course of 6 months or a year, that debt is going to be reduced, and it will look much like all the other names in the space. So we think that the low cash flow multiple is going to allow this stock to really perform over the course of 6 to 12 months as the debt is reduced, and as the company gets a following. The company's following, given its market cap, I would say is not anywhere near as broad as others. But that we think is the upside.
Yeah. And then EDM Resources in the same oil and gas
space.
So
EDM is it's a former producer. So in the case of EDM, we're not betting on whether or not the resource is in place. It's really a financing exercise on over the course of the next 1 to 2 years, getting this asset back into production, about raising the funds to do so in a intelligent manner, systematically, so that various tranches are raised at progressively higher prices as it gets closer to production. And that, we've only been in that for a short period of time, 3 or 4 months, but it's progressed by approximately 50% since the time we got involved after it announced results from its dense media separation study. So that study was successful. It showed that they are able to upgrade the feedstock, which will bring down the costs of processing the ore when production restarts.
Cannabis was such a strong tailwind, right? It gave you the ability to basically buy a big portfolio invest in a big portfolio of companies, Roger, and to take them public. Do you see any sort of big mega trend happening anytime soon in Canada that matches cannabis in the next 5
Well, I
years?
mean, the one that to me is the obvious one right now is this AI trend. There's articles in the paper today about the success of some of the AI stocks out there. Quinsam has not, I don't believe, invested in any AI stocks to date. The speculative upside is there, but to me, it is all a very speculative exercise. If I think I'd found a $1, $2, $3, $5 million market cap AI platform with some credibility, I might be interested. But as I look around in the marketplace now, I'm seeing lots of platforms at 30, 40, 50, 100 million market cap with no real revenue, no obvious signs of where the revenue is going to be coming from. To me, it's quite a dangerous space. Doesn't mean people won't make lots of money dabbling in it. When you have such violent stock price movements as we're seeing in AI right now, there are going to be some big winners and there are going to be some big losers. But I think in a couple of years' time, we will find out that most of the big winners are not the names that investors have participated in. NVIDIA will be a big winner, but will most of the speculative microcaps be winners? No, I predict that virtually all of them will be losers 2, 3, 4 years from now. There'll probably be 1 or 2 winners, and if you're lucky enough to have had the 1 or 2 winners, you might do quite well. And people who've traded well have lots of potential as well. But I think the fundamentals will not work out well for most people in the small cap AI space.
Having met so many founders and CEOs, Roger, over let's say 30 years that you've been in the business, what separates the exceptional, like the outsider founder and CEOs from the CEOs that don't really execute and make it happen for a company?
Well, perseverance for sure. I think that in the microcap space, frugality is very important. In some of these areas, like say AI, people often get caught up in the need to be at the forefront, and they will, when capital is available, they will spend heavily trying to be at the forefront, and being at the forefront is important, and so on. But the key is to keep your cost structure in a viable place, and to ensure that you always have enough cash on hand so that you've got a year or 2 years outlook without running into a financial wall. So many microcap companies end up in a situation where they have 3 months of cash, 6 months of cash, and then a vulture mentality sets in where the investment community sits on its hands and just lets the clock tick down, and then finances the company on very harsh terms. And the key is to be opportunistic in raising funds. Raise money when the market wants to give it to you, not when you need it. And going back to VitalHub, this is one of the things that VitalHub has done extremely well. It raises money in advance of an acquisition, so that when it sees an acquisition it likes, it's in a position to just write the check and make the deal. So many small cap companies have been in situations where they find an acquisition and they think, okay, I'm going to announce this acquisition, and then I'm going to figure out how to raise the money to fully complete it. But the problem is, the expectation is the announcement of the acquisition is going to do fabulous things for the stock, but sometimes it has the opposite effect, because then people know that a financing's coming and it stops the stock from performing until the financing's completed. So, I would say in the small cap, micro cap space, having looking for a company where it has the cash to avoid having to raise money is important. If you look at a company and see that cash is getting into a critical situation, best to just wait and wait for the financing to come and participate at that point.
You discovered some phenomenal companies, Roger, early on, but are there stories you can tell us where you had a company come across your desk, you discovered it early, but you passed on it, and if you can explain for what reasons that you did, and perhaps it went on to become a very successful company?
Oh, I mean, there's far too many to go over the list. There's, in the course of 10 years at Quinsam and 20 years elsewhere before that, there have been hundreds of things that I bought, hundreds of things that I passed on, passed on ones that have imploded and passed on ones that have been highly successful. So I guess I look at it as a long run, kind of portfolio exercise. The key is over time to have more winners than losers, and in the microcap space, one good winner like California Nanotechnologies, where you make 10 times your money, will make up for a lot of companies that don't work out so well. So the key for me is never bet the farm. If you're running a portfolio in this space, you've got to realize that there's always going to be volatility. There's going to be companies that, despite all the best analysis and work, still don't work out as planned. And you also have to realize there are going to be times where the market just doesn't care about things. And even if you've got a great business, when microcap markets are bad, there can be complete illiquidity in the microcap publicly traded space. So you have to have a portfolio that is able to withstand that, and that sort of comes back to the the history of Quinsam, that in my investment life prior to Quinsam, I was running a public microcap focused mutual fund, and the problem in the microcap public space is that when times get tough, as they did in microcaps in 2008, you start getting mutual fund redemption orders every day. And the problem is it's very difficult to exit microcap stocks when times are tough. And it was a very tough experience being in the microcap space in the 2008 meltdown. So when we revitalized and launched Quinsam in the 2012 2013 area, 2008 was still quite fresh in everybody's mind. And the beauty of the corporate structure is that the portfolio does not have to be sold when times are tough. People can sell their Quinsam shares, and it might hurt the Quinsam share price, but the portfolio is not damaged. It's not having to sell its best ideas in 2008 because they are the ones that you happen to be able to sell in a tough market. So, I think the key is ensuring that you're able to see through to the other side when you get into a very tough microcap market. You've got to have the strength to hold on. And you also have to have the confidence that the things that you've got in the portfolio are things that should be held on to.
Absolutely, because in the cases of California Nanotech and the case of VitalHub, these are not overnight success stories. This was like a decade-long story just to get some momentum going and the catalyst to work out. 2008 was very bad. 2022, 2023 was equally bad. Basically, the liquidity dried up in the market for microcaps. Improvements started happening in 2024. How do you see the market in 2025 shaping up?
Well, obviously, for the time being, it looks good. There's increasing interest in microcaps. It's probably the best it's been in 2 or 3 years. There are strength in a number of areas. Obviously, AI is quite robust these days, but I would say in general, there's a higher level of interest in microcaps. People are, as they do after a couple of years, a couple of good years in big caps, the investors start to reach down into the smaller microcap tier, looking to boost performance, looking to ensure they don't fall behind in, comparisons to other investors. So what we're seeing now is sort of what typically happens after 2 or 3 good years in the market. People reach down and microcaps start to do better. So right now everything looks good, but as we know, the world is full of risks right now, and there's a lot of unpredictability in terms of U.S. politics, in terms of Russia, Ukraine, in terms of China. It's very easy to see where the negative surprise could come at any point. And, I think, we're in a market where everything is positive until it very suddenly will not be. So I think the trick for 2025 is going to be, to make hay while the sun shines, but to be, I would say, quite careful that you don't get caught up in the hyperbolic bullishness that we're seeing in some areas. If we start to see signs of trouble in places like, for instance, AI, I would be heading for the exit quickly. These are the points in the market where, you make a lot of the money in small caps and in micro caps. So you need to be participating. This is the time to make your big wins. But at the same time, it is also the time where you set yourself up to have the stock down 90%. It's very easy to see. I keep picking on the AI names, but it's very easy to see how some of these stocks can fall 90% because there's no revenue multiple to fall back on. They're negative cash flow. They're going to have to raise money. Right now, people are willing to throw money at them left, right, and center. But this will end. It's very reminiscent of cannabis in 2017, 2018. But that there may be a year of fabulous gains until that happens.
Canada's strength is energy. How about the energy companies that are supporting the growth in data center requirements that power AI?
Yeah, well, obviously there's different aspects of energy. If you look at the oil patch is hugely out of favor. Cash flows in oil are very strong. The multiples are low. But I think the whole global warming, green energy, it is having an effect on particularly institutional demand, but probably retail demand as well for these companies. So they are, I would say, as a group, cheap and probably good investment vehicles. But they're becoming kind of a bit like cigarette companies. They're just not as acceptable as they used to be. But then you have in the AI space the electricity requirements. On the whole, these are not easy plays to make in the microcap space. In Canada, we used to have data center plays. There are really not any microcap data center plays around. There are some plays, and California Nanotechnologies would be one where, we have customers that are developing battery technologies, that are developing ultra high performance technologies that are related to some of these issues with data centers and green energy and so on. But for the most part, it's pretty hard to play that in the microcap space, other than going into say the AI technologies that are leading to the growth.
Yeah. So you're sitting on some significant capital now at Quinsam. Roger, where are you looking to deploy that capital? What's the overall plan? I know you can't really name names this time, but
we're looking for a significant transaction for Quinsam where basically we'll turn ourselves into an operating company. So we're looking, we're being quite selective. What I would like to find is a company that has all the sorts of characteristics we've been talking about. I'd like it to have a lot of operating leverage. I would like it to be not significantly cash flow negative, preferably cash flow positive. Something at a low EBITDA multiple, where there's some really interesting growth prospects ahead of it. Would be for us an interesting target. And right now, if you're a small growth company and you need $5 or $10 million, this is not necessarily easy money to find. At larger sizes, you attract the private equity players, but it's not big enough to attract investment dealers of to that size of financing. So if we can find a company that has that kind of financing need, or maybe a little bit larger, we could orchestrate raising some additional funds. We think we have a niche there where it is logical for us to think we should be able to find a good investment in that space and make a good deal for ourselves. So that's really what we're looking for. It would be great to find something that plays on some of these big investment themes that are in favor, but we want to be able to do it on good terms. So
is 2025 the year that this happens?
I think there's a good chance of it. We have a couple of large investments that we still have from the cannabis space. One of them we've talked about, Asynaptic. Assuming that the FDA trial goes ahead and its listing goes ahead, that is something that in 2025 we may see an exit on. It might take till 2026. But that one we're expecting liquidity on relatively soon, and I think that as 2025 progresses, there's a reasonable chance that we'll be able to do something with Quinsam. I don't think it'll be first half of the year, but as the year progresses, I think it's a good possibility.
So you've built a very strong network, Roger, over 30-year career in the MicroCap space. You have access to the best resources. But if you were to put yourself in the shoes of an aspiring MicroCap investor, you're starting out with $10,000 of capital. How do you set out to form that portfolio? What's the discovery process for you if you're in those shoes?
Well, I guess I would start off by if you've got a pool of capital, you want to have enough diversification that you're not betting the farm. But to quote someone that I used to work with, Mal Spooner, he used to refer to diversification as diversification. That at some point you're diluting your best ideas with bad ideas in order to lower risk. So I think you want to have your 3 or 4 deploy the money, probably reasonably equally, and as your ideas progress, even if your ideas start to do really well, make sure you take a little bit of money off the table, just to be sure, because it is in general a risky space. But I think you want to cast your net as broadly as possible. You're not going to find ideas just by financial modeling and financial screens of public companies. Many things will fall through the cracks. Financial modeling would never have identified AI companies. They'd never have identified cannabis companies. They're certainly never going to identify a successful resource exploration company or a biotech. It's just never going to happen because there are no financial metrics to look at. So I think you need to, look at, in the investment community, in the broader community, what are the themes that people are excited about? And, you can talk about AI, and you can talk about electricity demand, and you can talk about green energy. So, I think looking at those themes for ideas, but then trying to figure out, well, how do I find ideas in this space, not through financial screening? So, you can do various forms of, grassroots research to try to find these names. But then once you've found the name, through some qualitative process, then I think you want to look at it and say, well, okay, what leverage have I got here? What's the market cap? If it's already 50 million, in my experience, a 50 million company can double to 100 on speculation. But companies don't stay at $100 million valuation based on speculation for very long. They either have to develop, something very real, or sooner or later the market gets bored with the idea and moves on, typically. So, if you can find, microcap stocks that are in an interesting space like AI, where the market cap is not big, they haven't already had a run and led to disappointment, then try to get to know the company and see if, the story makes sense. The key with some of these companies is trying to figure out how they're going to get on the radar screen, because if they can go from being the unknown AI play to catching the wave, you can get, some really fantastic performance.
Yeah. If we were to go back to very young Roger Dent, what got you initially started in the world of investing? What was that spark in you, Roger, back then?
Oh, I think it was, the opportunity to see some, fantastic growth. I think, in the early days, if you see a story that can suddenly create significant value, and you can participate in it, you catch the interest. And I guess back in the early days, one of the big plays at the time was Diamat, which was looking for diamonds in Canada's north. And it was a fantastic performer, and that seeing that performance really caught my attention.
And then favorite investing book, Roger, of all time, what would it be that people should read who are watching this? I'm not sure if I have a favorite investing book. I like to take, different approaches to different stories. So, the classic value investing, books, Graham Dodd, for instance, that is important reading because it gives you, the basic fundamentals over the long run of, what's going to drive value and what's going to drive price.
But I think, reading books about bubbles are very important as well. Understanding, historically how, investment behavior has repeated itself time and again. There's the famous tulip bubble of the 1600s, but it's been repeated again and again. We've had, even in the last 20, 30 years, we've had the cannabis bubble, we've had the internet bubble, we had the mining exploration Bre-X bubble, and I think we are probably in the middle of an AI bubble right now. But at the time you're in the middle of it, there always seems to be a justification for why this is different and why this isn't like the bubbles of the past. And it almost always turns out to be the case that, no, it was just another bubble. So I would recommend that people read about that behavior and always be on the lookout for it. Because in the microcap world, it repeats approximately every 5 years.
Well, Roger, thanks a lot for being on the show. This has been a fun conversation. Thanks again.
Thanks a lot.